In this video, I'm going to go over how you can invest in covered call ETFs for passive income. So without further ado, let's get into the video. All right, so as I said, we're going to be talking about covered call ETFs for passive income. These are the things we're going to be covering today: an introduction to covered call ETFs and how they actually work. All right, I'm going to give you 3 covered call ETF ideas that you could consider for your portfolio. But before we go out and start buying anything, I'm going to show you how to research each of these covered call ETFs so you can make an informed decision. And then at the very end, I'm going to give you some very important considerations. Do not skip that part. All right. If you guys like this type of content, share the video. All right. Let's break the cycle. Let's get more people investing. Let's remove the gatekeeping so that more people have options in life. All right. That's the point of these videos. Disclaimer: I'm not a financial advisor or a financial planner of any sorts. Those are probably people you should talk to. I'm just some dude on YouTube. All right, let's get into it. All right, so covered call ETFs are exchange-traded funds that utilize a covered call strategy, which involves holding a portfolio of stocks and writing call options against them to generate income. This strategy aims to provide additional income through option premiums while holding the underlying assets for potential capital appreciation. I know that's a lot, and I'm going to show you exactly how that works. All right. So this is what we're going to cover right here. All right. Let's pretend you're an investor and you own 100 shares of company ABC, and each share is valued at 50 bucks. And then you get this bright idea that you want to do a call option against them, right? You want to do a strike price of $55, and in return, you're going to get a premium of $2 per share. What this means is that you're going to put a strike price. Let's say you predict that these shares are going to be worth $55 in the future, let's say a month. So you put a call option out there. And in return, you're going to get $2 worth of premium for every share. So 2 scenarios will happen during this time. And you're either going to have options exercised or options expired. All right. Someone has to buy that option or that contract. So we're going to call them the buyer. You put it out to the market that you're going to sell 100 shares with a strike price of 55 bucks. And in return, you're going to get $2 worth of premium. And a buyer is going to come along and say, hey, I want that contract. So he's going to buy that. So 2 scenarios will happen at this point. Either the option will be exercised or the option will expire. So when the option is exercised, this is what happens. If the 100 shares you put out for company ABC, instead of rising to 55, it actually rises to $60, the option buyer will exercise the option to buy, right? That means you're going to have to sell 100 shares at $55 because that was the contract, right? You get to keep the $200 premium, right? Because it was $2 for every share. So you owned 100 shares, but you sold your shares for $55, losing $5 in potential gains. All right. So you sold 100 shares for $55, but they were worth $60, losing you $5 a share, but you got to keep the option premium either way. Now, the second scenario that'll play out is an option expire, right? If company ABC stays at 50 bucks or even goes lower, the buyer can choose to let that contract, that option expire worthless, right? They're not going to buy it, right? But you still get to keep that $2 premium, right? That $200. You get to still keep that. So pretty good, outcome, right? For not losing your shares. So, you can employ this strategy in different ways, right? With different shares or, whatever. I've never personally ever done options. I don't think I'm that smart, so I just never did it. Instead, what I did was I left it to the professionals. So income, the covered call ETF, right? And basically, a covered call ETF is going to own a basket of stocks, right? And they're going to have varying different shares, right? They're going to own 25 shares of ABC, DEF, GHI, all the way down to XYZ, right? They're going to own, 100, 200 different companies in that ETF. Now, instead of me, the investor, doing those covered calls and deciding, hey, in a month, these shares are going to be worth this much or worth that much, and then I collect the premium, what the ETF does is they actually have a fund manager who's going to write calls on your behalf for the ETF, right? So they're going to put calls against these shares, against those shares, against all the shares, right? They're going to write those call options. And then this two scenarios will play out, right? It doesn't matter if it's the ETF doing it on your behalf or if it's you doing it, with your own personal shares. The two scenarios are going to play out. The biggest difference is the ETF is going to pay you either quarterly or monthly, right? It's going to distribute that income to the investors, right? It's going to distribute the premiums as well as any potential gains from the options, from the call options. So that's how it works in kind of a nutshell. I hope this made it easy for you guys to understand. I know my screen's down here in the corner, but I hope this made it easy for you guys to understand. I'll actually include a link down below so you can get this little graph so it can kind of help, if you want to walk through it yourself. But anyways, let's get back into the presentation. All right, so that's how Covered Call works, and that's how Covered Call ETFs work. All right, so I'm going to give you 3 Covered Call ETF ideas, and as you guys know, I'm a big fan of spreadsheets, so I already got one built out for you guys, so let's get into that one. So for this example, for this video, I chose DIVO, I chose QYLD, and I chose JEPI. These are 3 very popular ETFs for covered calls. However, each of these different ETFs do something different. They do a little a different, flavor of covered call, ETFing, I guess. JP Morgan, they use ELNs, which are equity line notes. Basically, they're debt instruments put against the securities. If I read that correctly, and the Global X Nasdaq 100 covered call ETF QYLD. That's your kind of vanilla, covered call strategy that they employ. And then you have the Amplify Enhanced Dividend Income ETF. They also do a flavor of covered call optioning, right? So we have DIVO, QYLD, and JEPI. Expense ratios are here, and you guys already know I'm a big fan of low expense ratios. These are the different holdings that they're doing covered calls against. So 40 holdings for DIVO, 102 for QYLD, and then 135 for JEPI. And then these are the yields, right? And these pay monthly. Now, before we start buying all of them and start, going crazy, I want to show you some things here in just a minute, all right? But we know that DIVO pays, a 4.47% yield when annualized. QYLD is about 11.57%, and then JEPI is 7.28%. I've seen JEPI go up as high as 9 and 10%. So for them to drop it is kind of interesting. And then of course, they're going to pay you monthly. Now, always check. I got to put a little note here. Always check for updated information, right? And you can go to their websites to get that information, all right? You should always be checking for updates. This video, by the time you watch it, maybe in the future, all this stuff is probably wrong at that point. So just make sure you check the websites, okay? All right, so let's go back to this presentation. All right, cool. So let's research the covered call ETFs, all right? And this is gonna surprise you. I promise you this will surprise you. So we're gonna go to Seeking Alpha like we always do. You can sign up for a free account. For this example, I'm using a free account because I want you guys to be able to see what it looks like. So we're going to go down to comparisons like we always do. And we're going to compare QYLD. We're going to compare JEPI. And we're going to compare DIVO. Now, in this example, we want to find out which one is the best one to invest in, right? That's what we're here for. We want to know which one we're going to be putting money into. And I'm going to give you kind of my thought process on all of this, all right? So a lot of it's going to be ad lib, not scripted. It's going to just be off the cuff. So we have all 3 of our items here, all 3 of our ETFs here. And as you guys know, I'm a big fan of track records. So we know that QYLD has been around since 2013. JEPI has been around since 2020 during the pandemic. And then DIVO came out in 2016, all right? So QYLD, in terms of track record, has it, JEPI and DIVO are still fairly young, but DIVO, does have some track record to it. All right, we see that the expense ratio is pretty high for QYLD. It's sitting at 0.6%. That's pretty high. 35% or 0.35% for JEPI, and then 0.56 for DIVO. We see that QYLD has $8 billion in assets under management. That means a lot of investors are putting money into this fund. We see JEPI has a whopping $33.92 billion, and then DIVO has $3.34 billion. All right, let's compare all three. So in terms of price return, it looks like DIVO is winning, right? And this is just price return, and this is only for the year, okay? Just some background information, QYLD actually invests using the NASDAQ 100 index, okay? So it's something like QQQ, right? So it's following that index and then writing call options against the companies in that index. JEPI, I'm not quite sure what index they're following, if any, but something to look into. I think if I remember correctly, I thought it was an S&P 500 variant, but I could be wrong. And then I'm not sure about DIVO, right? DIVO's, they only have 40 holdings, so it can't be that much. All right, so we go back here. Price return, but we want to look at total return, right? And we see that DIVO is crushing it. DIVO is crushing it for the year at 14.76%, right? JEPI is killing it at 10.25%, and then QYLD at 10.79%. All right, these are pretty good. I mean, when you compare this to some of the other ETFs like, VOO or maybe QQQ, they're not doing too bad, and you're getting income, so that's always good. But let's zoom out a little bit to find out which of these three are actually the best. So we see on a total return basis that QYLD is actually underperformed by quite a bit since early 2019 or late 2019, right? So it's actually underperformed by quite a bit. JEPI has picked up, but again, you gotta remember that JEPI came out in the middle of 2020, right? So you just keep that in the back of your mind. And DIVO, when compared, has actually been crushing it. All right, 72.25% return over the last 5 years. Okay, keep those in your mind. All right. So we go down a little bit more. We see the dividend growth across all of them is pretty bad, but they all pay monthly. Right, we see the CAGR is it's negative for QYLD. They don't have one for JEPI yet, and DIVO has a 2.88% 5-year CAGR. So good, kudos to them. They win this round. All right, so performance, 10-year QYLD has not returned actually anything. They've actually been under almost 30%, right, over the last 10 years. So if you invested, let's say $100,000 into QYLD, even though it was paying you those really big, yields, you actually lost 30% of the value of your portfolio. All right, again, something to think about. DIVO for the last 5 years has returned 29.51%, and QYLD, again, in the red, 23.47%. And then, as we get closer, again, 2020, 3-year, JEPI, again, not doing so well. QYLD, not doing so well. DIVO looks like it's doing very well. All right. Number of holdings, like I said, 102. So JEPI can't be following a S&P 500 variant because it has only 135 companies. And then DIVO, 40. Okay, so I want to show you guys this next piece, all right? All right, in this next piece, I'm gonna show you the importance of looking at each individual holding and then what you can find from digging inside their dividend history. All right, so first up, and again, this is all on a free account using seekingalpha.com. So if you go to search for QYLD, this is what you're gonna get. But here's something interesting. If we look at the max, we see that QYLD has actually dropped almost 30% since its fund's inception date, okay? Since its fund's inception date. So if you put $10,000 in when QYLD first came out, it'd probably be worth, around $7,000, okay? Of course, it depends on what you're doing with the dividends, if you're reinvesting them or going out to spend them. But, beside the point, I wanna show you the dividend tab, All right, you're going to click the dividend tab, and we're going to go to dividend history. And this might surprise you. So yes, all these covered call ETFs, they have these, very nice yields, mouth-watering, 10%, 11%, 12%. But we have to look at the dividend history to see if that story is actually true. So we go down to dividend history, and we see over the 5 years that it paints a different picture, right? We have right here difference in payouts for each of the shares, right, over the last 5 years. And this one, I'm not sure what this is. So I know DIVO has the same thing, but don't take that for anything really. What you really want to know is that how stable has the dividend been? Because again, when you're buying these income ETFs, you're looking for predictability. You're looking for income, right? And if it constantly changes from month to month, then that would be a risk, right? That would be a cause for concern, especially as you're getting older and you're looking for predictable income, okay? If you can deal with, changing payments or dates or months being more than other months, then that's fine. That's entirely up to you. But let's look at like the max, right? Let's see what that looks like. Again, this paints a much different picture, right? You can see that the dividend income has just been all over the place. It hasn't really been stable. Could be a good thing, could be a bad thing. It really all depends on you as the investor. All right, now let's look at JEPI or JP Morgan's equity premium income ETF. All right, so if we look, and that's JEPI. So if we go to the max, we see that JEPI, since its inception date back in 2020, has returned 13%. Not bad, all right? Not bad, better than QYLD for sure, all right? And it's been boasting about a 7% yield. I've seen it go as high as like 10%, all right? So it went down, is kind of, I won't say alarming, but I've also seen it hover around 8% for a long time too. So again, just something to keep in the back of your mind. But again, we're going to go to dividends, and we're going to go to dividend history tab, and we're going to look down, right? Again, JEPI, they only have 4 years of, a track record, but even then, I mean, we can see that the payments have been kind of all over the place. 33, 36, 35, 30, 43, 61, 48, like it's been all over the place, right? So again, if you're looking for predictable income, predictable cash flow, predictable dividend, this ETF may not fit that bill, but if, you can deal with every month being different, then that's entirely up to you. Again, when you're buying these ETFs, sometimes, and this is why it's important to do your research, sometimes they might pay out, certain amount of money for each shares, right? So an example is, let's say you make $100 in January. Then in February, you make $80. And then in March, you make $110, right? It's all over the place. So I don't know. It really all depends on you. I know if I was much older in life, I would probably be looking for predictable income where the dividend is not really changing, going down as much. You're going to want that, that slow, steady slope to the top. So we know what JEPI looks like. We know its return since its inception date. So let's look at DIVO. Oh, whoops. So here's DIVO. Since its inception date in 2016, late 2016, it's returned 59.36%. All right, it's doing really well. And a lot of people will compare DIVO with SCHD, even though DIVO uses, cover call options. They will compare DIVO with SCHD, and I'll show you why. So SCHD, as you guys know, is the king of dividend income ETFs. It has a consistent history of like 13 years of consistently growing their dividend and paying out, right? You're not going to get these wild swings like you will with QYLD or with JEPI. So if we go to the dividends, and again, this adds to the story, gives you a little more information. If we look at the dividend history, this is where the story gets really interesting. So we see that DIVO had that massive, payout in 2019. Again, I don't know what that was. I didn't research it down that far, but we see over the life of DIVO, since its inception date, they had the first year that was this is probably when they were doing quarterly payouts, I would guess. But ever since then, it's just been kind of consistent. It hasn't really been fluctuating much, and it's just, again, predictable income. That's what you're looking for. If we look at the 1 year, again, same thing. It's predictable. So you as the investor, you have to decide what makes more sense for you. If you could deal with the wild swings, the month-to-month changes in income, or do you want steady, predictable income, right? That's something that you will have to look at and you will have to decide. Even though these are very sexy, they're paying out some crazy returns, or lack of, but they're giving you monthly dividend income. You want to be careful in how you integrate covered call ETFs or income ETFs into your portfolio. And I'll show you why. Let's add VOO to this. It's just a simple run-of-the-mill S&P 500 index, right? Let's compare these now. All right. We don't really care about this. We're actually want to compare returns. All right. So these are the returns for 1 year. Again, a simple index like VOO has returned 20% on the year, right? And this is for price return. If we go down to total return, and I know you guys can't see this because of my screen is somewhere down here, but let me see if I can get it up. All right. So as you guys can see, hopefully you can see, VOO has been crushing it this year. They've just done very well. Now, if we zoom out, it tells a different story. Let's zoom out 3 years. Again, VOO is returned 35% versus DIVO, JEPI, and QYLD. DIVO's coming in second place, JEPI's coming in third, and then QYLD very last, right? So even something as simple as an index is returning more money, or I'm sorry, it's growing more money than the other ones, right? Because again, DIVO, JEPI, and QYLD, they're income-focused ETFs. They're going to be paying you. And whether you're using that and reinvesting and buying more shares, or using that to go grocery shopping or whatever, I don't know. But on a total return basis, you have to take into account that VOO by itself is just crushing these other ones, all right? So if we zoom out a little bit more to the 5 year, and I've already looked at the 10 year and I was like, holy crap. But if we look at the 5 year, VOO again has returned 100%, right? That's through the pandemic, that's through this bear market we've been into, high interest rates, wars, energy crises, inflation, all of that. VOO still returned 100%. Over the last 5 years, right? So if you invested, let's say a hypothetical $10,000, you'd have $20,000, right? And then you could just double that for anything else, right? If you invested $100,000, you'd have $200,000. If you invested, $50,000, you'd have $100,000. So it's returned 100%, right? It's beaten out DIVO, JEPI, and QYLD altogether. So I just wanted to show you guys that, all right? Just so you're aware. When you're buying these income ETFs, they have to serve a very specific reason or a very specific purpose. If you're an income investor and you want cash flow, you want dividend income, all that kind of stuff, you could go with these other ones. You absolutely could. But if you're investing for the long term and you want to build your wealth, then you probably will want to go with something like VOO, an S&P 500 index. These would be great maybe as a smaller allocation in your portfolio than something like 50%, right? Because if you're investing, let's say you had $1,000 in DIVO and you're constantly putting money into it, you're still going to be underperforming the greater market, S&P 500, right? And for you to get any meaningful dividend return, you're going to have to put a lot of money into DIVO or even JEPI or even QYLD, right? So again, it really depends on you, your risk tolerance, your time horizon, and what you want. What are you looking for? Are you looking for income? Maybe it's a mix of income and growth. Maybe it's all income, Maybe it's, fill in the blank. So I just wanted to show you guys that, all right? So let's get back to that presentation. I showed you guys how to research the ETFs, all right? Just quick plug for my Skool community. If you guys like this type of content, I have a community, a bunch of investors. I have an investing masterclass light series in the classroom for free. It's all free to join, all right? I don't need a credit card. I don't need any of that. We're going to be doing coaching calls in the future. I'll put a link down below in the description. Okay, so here's some very important considerations before you go out and start buying anything. Tax considerations, the biggest one of them all right? If you're an income investor, these ETFs return capital in a different way, right? They pay you in a dividend yield, but the dividend yield or the dividend is a mixture of different sources, right? You have a qualified dividend, you have ordinary income, or you have return of capital. Those are the three classifications of dividend income. When you're getting qualified dividend income or ordinary income, they're taxed differently. Whereas return of capital, they're just returning your money to you, right? Each of these different ETFs have different tax implications, and that you have to research into. You have to read more through the fund's website to understand what their dividend is and where it's coming from. Because again, if you're making $10,000 in dividends, that's all well and good. But if you're getting taxed to high hell because, either capital gains or, your ordinary income tax bracket, then what's the point, right? So again, you have to kind of come to these own conclusions yourself. So if you want to understand the dividend and why it's so high, read the vendor's website and understand where that dividend is actually coming from. You also face capital erosion, right? There's a capital erosion risk. So you remember in that example I gave you guys that two options will be exercised, right? Let's say the ETF just constantly keeps getting it wrong and they keep selling shares at a higher price and collecting a lower price, right? They keep selling shares at they keep selling shares at $55, but all the shares were worth 60. If they keep doing this, the NAV, the net asset value of that ETF is going to go down. That is capital erosion to you, and there's nothing you can do about it, right? You don't have a say in the ETF. The fund manager is taking care of all that for you, right? And they just produce a, yearly return, quarterly return. They give you kind of the update on the performance, but they don't tell you what shares they're writing call options against. They don't tell you how much they're losing or any of that. You just get a simple document at the end of the year that tells you how it's doing, right? And then you also get, your tax documents. But you face capital erosion when you invest in these ETFs. So again, that's something you have to consider. It is part of the risk, right? It is part of the game of investing in these. So that's what capital erosion risk is. There's also limited upside potential. Again, because of the way they're writing these call options, they might be, you might be losing that $5 gain on each of the shares. Again, you don't have a say. You get to collect that option premium, which is always nice, but you could be losing on, you could be losing $3 for every share that the ETF is selling or that the fund is selling. So again, just something to be aware of, something to think about. And then you have greater downside risk, right? So if a market crash happens, all the ETFs that are doing covered call options, they could face even more potential losses because, other people could either be buying those contracts up or the underlying securities are doing so bad that the ETF also does bad. So again, these are all risks with investing into covered call ETFs. So I hope this video was valuable for you guys. I really do. A lot of research went into this. I used to invest in covered call ETFs. I no longer do because it just doesn't fit my investing style. So if you guys enjoyed this, I'll see you guys in the next video. Peace.